Hey guys, welcome to another video. Today I'm going to talk about cryptocurrency trading. Investing in cryptocurrency is a great way to make some cash, and it's a lot easier than you think. Crypto trading. What's cryptocurrency trading? Cryptocurrency trading may be the act of speculating on cryptocurrency price movements with a CFD trading account, or investing the underlying coins via an exchange. CFD trading on cryptocurrencies. CFDs trading are derivatives, which allow you to speculate on cryptocurrency price movements without taking ownership of the underlying coins. You can go long if you believe a cryptocurrency will rise in value, or short if you feel it will fall. Both are leveraged products, meaning you merely need to set up a little deposit, referred to as margin, to get full contact with the underlying market. Your loss or profit are still calculated in line with the full size of your situation, so leverage will magnify both profits and losses. Investing cryptocurrencies via an exchange. When you get cryptocurrencies via an exchange, you get the coins themselves. You'll have to create an exchange account, set up the entire value of the asset to open a posture, and store the cryptocurrency tokens within your own wallet until you're prepared to sell. Exchanges bring their own steep learning curve, as you'll have to get to grips with the technology involved and learning to make sense of the info. Many exchanges likewise have limits on what much you can deposit, while accounts can be extremely expensive to maintain. Just how do cryptocurrency markets work? Cryptocurrency markets are decentralized. This means they aren't issued or backed by a central authority like a government. Instead, they find a network of computers. However, cryptocurrencies can be purchased and sold via exchanges and stored in wallets. Unlike traditional currencies, cryptocurrencies exist only as a shared digital record of ownership, stored on a blockchain. Whenever a user really wants to send cryptocurrency units to some other user, they send it compared to that user's digital wallet. The transaction isn't considered final until it's been verified and put into the blockchain through an activity called mining. That is also how new cryptocurrency tokens are often created. What is blockchain? A blockchain is a shared digital register of recorded data. For cryptocurrencies, this can be a transaction history for each unit of the cryptocurrency, which ultimately shows how ownership has changed as time passes. Blockchain functions by recording transactions in blocks, with new blocks added at the front end of the chain. Blockchain technology has unique security features that normal computer files don't have. Network consensus. A blockchain file is always stored on multiple computers across a network, instead of in one location, and is normally readable by everyone within the network. This helps it be both transparent and incredibly difficult to alter, without one weak point susceptible to hacks, or human or software error. Cryptography. Blocks are linked together by cryptography, complex mathematics, and computer science. Any try to alter data disrupts the cryptographic links between blocks, and will quickly be defined as fraudulent by computers in the network. What's cryptocurrency mining? Cryptocurrency mining may be the process where recent cryptocurrency transactions are checked and new blocks are put into the blockchain. Checking transactions. Mining computers select pending transactions from a pool and check to ensure the sender has sufficient funds to complete the transaction. This calls for checking the transaction details against the transaction history stored in the blockchain. Another check confirms that the sender authorized the transfer of funds utilizing their private key. Creating a fresh block. Mining computers compile valid transactions right into a new block and try to generate the cryptographic connect to the prior block by finding a remedy to a complex algorithm. Whenever a computer succeeds in generating the hyperlink, it adds the block to its version of the blockchain file and broadcasts the update over the network. What moves cryptocurrency markets? Cryptocurrency markets move according to supply and demand. However, because they are decentralized, they have a tendency to remain free from a lot of the economic and political concerns that affect traditional currencies. Since there is still a whole lot of uncertainty surrounding cryptocurrencies, the next factors can have a substantial effect on their prices. Supply, the full total number of coins and the rate of which they are released, destroyed or lost. Market capitalization, the worthiness of all coins around and how users perceive this to be developing. Press, what sort of cryptocurrency is portrayed in the media and just how much coverage it really is getting. Integration, the extent to that your cryptocurrency easily integrates into existing infrastructure, such as for example e-commerce payment systems. Key events, major events such as for example regulatory updates, security breaches and economic setbacks. How does cryptocurrency trading work? With Henko Forex, you can trade cryptocurrencies with a CFD account, derivative products that assist you speculate on whether your selected cryptocurrency will rise or fall in value. Prices are quoted in traditional currencies, including the US dollar, and you never take ownership of the cryptocurrency itself. CFDs are leveraged products, therefore you can open a posture for only a fraction of the entire value of the trade. Although leveraged products can magnify your earnings, they are able to also magnify losses if the marketplace moves against you. What's the spread in cryptocurrency trading? The spread may be the difference between the trade prices quoted for a cryptocurrency. Like many financial markets, when you open a posture on a cryptocurrency market, you'll be offered two prices. If you wish to open an extended position, you trade at the buy price, which is slightly above the marketplace price. If you would like to open a brief position, you trade at the sell price, slightly below the marketplace price. Exactly what is a lot in cryptocurrency trading? Cryptocurrencies tend to be traded in lots, batches of cryptocurrency tokens used to standardize how big is trades. As cryptocurrencies have become volatile, lots have a tendency to be really small, most are just one single unit of the bottom cryptocurrency. However, some cryptocurrencies are traded in bigger lots. What's leverage in cryptocurrency trading? Leverage is the method of gaining exposure to huge amounts of cryptocurrency and never have to pay the entire value of your trade up front. Instead, you deposit a small deposit, referred to as margin. When you close a leveraged position, your loss or profit is based on the entire size of the trade. While leverage will magnify your earnings, it also brings the chance of amplified losses, including losses that may exceed your margin on a person trade. Leverage trading therefore helps it be extremely important to understand how exactly to manage your risk. What's margin in cryptocurrency trading? Margin is an integral part of leverage trading. It's the term used to spell it out, the original deposit you set up to open and keep maintaining a leveraged position. If you are trading cryptocurrencies on margin, understand that your margin requirement changes based on your broker and what size your trade size is. Margin is normally expressed as a share of the entire position. A trade on Bitcoin, BTC, for example, may need 15% of the full total value of the positioning to be paid for it to be opened. So rather than depositing $5,000, you just need to deposit $750. Exactly what is a pip in cryptocurrency trading? Pips will be the units used to measure movement in the price tag on a cryptocurrency, and make reference to a one-digit movement in the purchase price at a particular level. Generally, valuable cryptocurrencies are traded at the dollar level, so a move from a cost of $190 to $191, for instance, means that the cryptocurrency has moved an individual pip. However, some lower-value cryptocurrencies are traded at different scales, in which a pip could be a cent or perhaps a fraction of a cent. It's important to browse the details on your selected trading platform to make sure you understand the particular level of which price movements will be measured before you place a trade.